Merry Christmas, ladies and gentlemen. Asian guy here. I know exactly what you're doing right now. You're probably sitting on the couch, sinking into those cushions, digesting a heavy meal. Your belt is loosened, your guard is down. Maybe the kids are playing with their new toys scattered across the living room floor. Maybe you're having a drink with your relatives, sharing stories, laughing about nothing in particular. The world feels normal, safe, predictable. And somewhere in the middle of all this holiday warmth, you're checking your phone. You can't help yourself. You're looking at the silver price, and you see it sitting there flat, peaceful, utterly calm. It is trading around $71.94 to $72.10. It hasn't moved an inch in 24 hours, not a single tick. The charts are frozen like a photograph. The noise has stopped. The volatility that kept you awake at night for the past 12 months has vanished into thin air. For the first time in what feels like an eternity, the screaming volatility of the silver market has gone completely silent. It feels safe, doesn't it? It feels like the war is finally over for the year. It feels like you can finally relax, close your laptop, pour yourself another drink, and wait patiently for January to arrive. But I'm turning on this camera on Christmas night at a time when I should be with my own family because I need to tell you something urgent. I need to tell you something that your broker will not tell you. I need to tell you something that the financial news channels, who are currently airing pre-recorded year-end review fluff pieces and greatest hits compilations, are completely ignoring. This silence you're witnessing right now, this peace that feels so comforting, it is a lie. It is a dangerous illusion. We are currently standing in the eye of a hurricane, and tomorrow morning, December 26th, the eye wall hits with full force. We are entering a specific dangerous window of time that professional traders whisper about in hushed tones. We are entering the period known as Ghost Week. If you have been trading for less than 5 years, you might not even know what this is. You might think the market is just closed or open, binary, simple. You might think a Tuesday is the same as a Friday, that time moves uniformly through the trading week. But in the futures market, in the brutal, leveraged, unforgiving world of the commodities exchange, time is not linear. Time bends. Time creates pockets of extreme danger. Ghost Week is the trading period between Christmas Day and New Year's Day. Specifically, it is the trading sessions that run from December 26th all the way through to January 2nd. During this week, the entire structure of the global financial system fundamentally changes. The architecture collapses. Think about who normally moves the market on a regular Tuesday in October. It is the senior risk managers at JP Morgan with their 3 decades of experience. It is the head traders at Bridgewater with their billion-dollar mandates. It is the sophisticated algorithmic trading desks in London and Hong Kong operating with unlimited capital and lightning-fast execution. These are people with decades of hard-won experience, people who have survived multiple market cycles, people who have seen every trick in the book. And more importantly, they are people with the authority to deploy billions upon billions of dollars of capital to stabilize prices, to absorb shocks, to prevent the market from dislocating. But right now, at this very moment, those people are gone. They have disappeared. They're in Aspen, skiing down black diamond slopes. They're in St. Bart's on yachts anchored in crystal blue water. They're with their families in places where their phones don't work, where Bloomberg terminals don't exist. They have turned off their trading terminals. They have flattened their entire books. They have reduced their exposure to zero. They have handed the keys to the castle, the nuclear codes, to the skeleton crew. The skeleton crew is made up of junior traders fresh out of college, interns who are just happy to have a job, and automated maintenance algorithms running on low power mode, executing pre-programmed instructions. Their marching orders are painfully simple. Don't do anything stupid. Don't take any risks. Don't make any decisions. Just keep the lights on until the boss comes back in January. Survive the week without creating a disaster. This means that the volume, the lifeblood of the market, the amount of actual money flowing through the veins of the trading system, drops catastrophically. We're talking about a 70% to 90% decline in liquidity. And this creates the most dangerous phenomenon in all of finance, the liquidity vacuum. I need to explain the liquidity vacuum to you technically and precisely because if you are holding leverage right now, if you have futures contracts or options positions, this concept is going to determine whether you get rich next week or whether you get completely liquidated and wiped out. Imagine the silver market is a frozen lake in the middle of winter. On a normal day, during regular market conditions, the ice is 10 feet thick, solid, unbreakable. You can drive a fully loaded semi-truck over it without even hearing a crack. If a massive sell order comes in, say someone dumps 5,000 contracts in a single block trade, the ice holds firm. The price dips maybe 10 cents, maybe 20 cents, and then the limit orders that are stacked throughout the order book immediately absorb the shock like a cushion. The limit orders are the walls of the market. They are the safety net. There are literally thousands of traders, both institutional and retail, waiting patiently to buy at $71.90, at $71.80, at $71.70. These orders act like a buffer zone. They cushion the blow of large trades, they prevent the price from falling off a cliff, they create stability. But during Ghost Week, something terrifying happens. The ice melts. It becomes paper thin, fragile, ready to crack at the slightest pressure. Why? Because the senior traders who normally place those thousands of stabilizing limit orders are gone. Those walls, those safety nets, those cushions, they're removed from the order book entirely. The protection disappears. The walls vanish into thin air. So now we have a market with zero depth. No cushion, no protection. If a large order hits the market tomorrow, let's say a sovereign wealth fund in the Middle East decides to rebalance their entire commodity portfolio, or a panicked hedge fund desperately needs to cover a massive short position before year end, that order will not find a buyer at $71.90. It won't find a buyer at $71.80. It won't even find a buyer at $71. That sell order might have to drop all the way down to $68, maybe even $65, just to find the first willing buyer sitting in the darkness. And we call this slippage. We call this an air pocket. We call this a liquidity void. And here's what makes it truly terrifying. It works both ways. The knife cuts in both directions. If a large buy order hits the market tomorrow, maybe because of a geopolitical headline in Venezuela that we'll discuss in extensive detail in part 2, maybe because of a supply disruption in Peru, maybe because of a rumor about central bank buying, the price won't politely tick up to $72.10, then $72.20, then $72.30. No, it will teleport, it will gap violently from $72 straight to $75 in a single 1-minute candle that looks like a glitch in the matrix. Why does this happen? Because there's nobody standing in the way to sell it. The institutional sellers who would normally provide liquidity are on vacation. They're unreachable. The order book is empty on the sell side. So the price has to jump from level to level, hunting desperately for someone, anyone, willing to part with their silver at any price. So Ghost Week is not a time of peace and quiet like it appears on the surface. It is a time of extreme fragility, of maximum danger. The market is like a room completely filled with gasoline fumes. It looks calm, it looks safe, the air is still, but one single spark, one unexpected tweet from a government official, one headline from a mining company, one rumor on social media, any of these can blow the roof off the building in a catastrophic explosion. You might be thinking right now, Asian guy, you're exaggerating, you're fear-mongering. Nothing ever happens during the holidays. Everyone is relaxed. The markets are quiet. Oh, really? Let's look at the historical record. Let's examine what actually happens when the professionals go home. Christmas 2010. Silver was trading quietly, peacefully around $20 per ounce. Everyone in the industry went on holiday. The trading floors were empty. The phones stopped ringing. But by the first week of January 2011, silver had ripped violently higher, igniting the massive run that eventually took us all the way to $50 in April. The Ghost Week was the launch pad. It was the spark that lit the fuse. Christmas 2020. The early beginnings of the Reddit silver squeeze movement started bubbling up in extremely thin holiday trading. Message boards were lighting up, retail traders were coordinating, and by late January 2021, we were seeing violent gap-ups on Sunday night market opens that defied all logic. Flash crash of 2019 in the Japanese yen. Remember that? Remember the flash crash that happened on January 3rd during the Asian holiday window when both New York and London were still sleeping off New Year's celebrations? The yen moved 4% in literal minutes. 4%. In a major global currency. Why did it happen? Because there was absolutely no liquidity in the market, no institutional buyers, no sellers, just algorithms fighting each other in the dark. History tells us, if we're willing to listen, that Ghost Week is when the unexpected happens. It is when the fat tails of the probability distribution show up and bite you. It is when the black swan events materialize. And 2025 is not 2010. The world has changed. In 2010, the world was relatively stable, relatively predictable. Central banks were behaving normally. Geopolitics were manageable. In 2025, we have a proxy war unfolding in South America. We have a full blockade on Venezuela, disrupting global oil and mining operations. We have a Federal Reserve that just openly capitulated on inflation after years of denial. And we have a silver market that is up 140% year to date, which is absolutely unprecedented in modern trading history. The potential energy stored in this market right now, coiled like a spring, is higher than it has ever been at any point in history. We are sitting on top of a pressure cooker with the valve welded shut. Let's look at the board as it stands tonight, Christmas Day 2025, and assess where we are. We have closed the week at an all-time high of $71 spot price. That's not a typo, not a glitch, an all-time high. We have successfully broken through the iron ceiling of $70 that held for decades. The psychological impact of this breakthrough cannot be overstated. For 45 years, $50 was the absolute ceiling, the roof, the barrier that could not be crossed. Once we finally broke through that barrier, $70 became the new mental obstacle, the new wall in traders' minds. Now we are above it. We are in uncharted territory. Technically speaking, we are in blue sky territory. There is no resistance above us. There are no previous bag holders from prior tops looking to sell and break even. The only people left in this trade are the winners, the believers, the diamond hands who rode it all the way up. But here is the danger that nobody is talking about. The technical indicators are flashing bright red warning signals. The RSI, the Relative Strength Index, is screaming overbought. We're at levels above 80. The Daily Sentiment Index is at 95% bullish. Everyone is a bull. Everyone is optimistic. In a normal market with normal liquidity, this would scream pullback. It would scream profit taking. It would scream that a correction is imminent. And usually, typically in a normal year, traders would take their profits. They would sell before the end of the year to lock in their gains, to secure their bonuses, to pay their taxes. It's standard operating procedure. But this year, they aren't selling. Nobody is hitting the sell button. Why? Because of the Asahi vault drain we witnessed on December 23rd. The smart money, the institutional players, the people with inside information, they know that there is no physical metal left in the system. They know that if they sell their paper contract at $72 to take a quick profit, they might never ever get back in. They might wake up on January 2nd and see the price at $85 or $90 or even higher, and they'll be locked out forever. So nobody is selling. Everyone is gripping their positions with white knuckles. Everyone is holding their breath, waiting to see what happens next. We have a market with maximum bullish pressure, maximum optimism, maximum positioning, all confined within a minimum liquidity environment. It is the physics of an explosion waiting to happen. All the ingredients are present. We just need the match. So what happens tomorrow, December 26th, when the markets reopen? The exchanges will open for a shortened trading session. The lights will turn on, the screens will glow, but volume will be virtually non-existent. We might see 10% of normal trading activity if we're lucky. But here's what most people don't understand. The arbitrage bots that connect the New York COMEX to the Shanghai Futures Exchange will still be running 24/7. These are sophisticated algorithms that exploit price differences between markets. They never sleep, they never take holidays, they never go on vacation. And remember this critical fact, Shanghai is currently trading at $77 per ounce. New York is at $72. That $5 gap is not just a number on a screen. It's effectively a bungee cord, a rubber band, a physical force pulling New York higher. Tomorrow, even with catastrophically low volume, that bungee cord is going to be pulling with maximum tension. If just one industrial buyer, maybe a battery plant in China that didn't shut down for Christmas, maybe a solar panel manufacturer that's running 24/7, decides to hedge their January delivery tomorrow, they could send the price vertical in minutes, and if we gap up tomorrow morning, if we open at $74 or $75, it sets the psychological tone for all of January. It triggers the FOMO, the fear of missing out, for every fund manager who is sitting at home watching. Every institutional player who is underweight commodities will panic. They'll be reaching for their phones, calling their junior traders, demanding to know why they don't own any silver. Now let me tell you something that very few people outside of professional trading desks understand. This is insider knowledge that I'm sharing with you. Ghost Week is not just about low volume. Ghost Week is about who is still working. And in the precious metals market specifically, there is one group that never takes a holiday, that never goes on vacation, that never stops working: the Asian trading desks. While New York is closed, while London is sleeping off champagne hangovers, the Shanghai Gold Exchange, the Tokyo Commodity Exchange, the Mumbai markets, they're all running at full capacity. Chinese traders don't celebrate Christmas. They're working, they're watching, they're waiting, and they are seeing the same thing we are seeing. They're seeing $77 Shanghai price versus $72 New York price. They're seeing empty vaults. They're seeing backwardation in the swap spreads. They're seeing the technical breakout. They know this is the moment. In every previous Ghost Week rally, 2010, 2020, 2015, the initial push came from Asia. Why? Because they're the only ones at their desks. They're the only ones with their hands on the buttons. They move first, and then when New York wakes up, they're forced to chase. There's also a specific technical pattern that happens almost every year during Ghost Week, and if you've been trading long enough, you've seen this pattern play out repeatedly. It's called the suppression release. Let me explain this carefully because it's crucial to understanding what might happen next week. Throughout the entire year, the big banks, the commercial traders, the entities with essentially unlimited capital, they actively suppress the silver price. Not because they're evil, not because of some grand conspiracy, but simply because they're short. They have massive short positions that they use for hedging purposes, for client obligations, for risk management. Suppressing the price is in their financial interest, so they do it systematically, mechanically, without emotion. Every time silver rallies too hard, they dump contracts. Every time momentum builds, they step in front of it. It's just business. But here's the thing about suppression. It requires constant active maintenance. It's like holding a beach ball underwater. You can do it, but you have to keep pushing down constantly. The moment you release pressure, even for a second, that beach ball explodes out of the water. During Ghost Week, the suppression teams go on vacation. The risk managers who execute the suppression strategy are not at their desks. The algorithms are running on low power mode with strict instructions not to take aggressive positions. The maintenance stops, the pressure releases, and the beach ball can finally pop out of the water and breathe. But Asian guy, you might ask, if this pattern happened in 2010 and happened again in 2020, why are you so worried about 2025? Why do you say this year is danger next week? Why is this time different? Because of one critical fundamental difference that changes everything. Inventory. In 2010, the COMEX vaults were full to the brim. There were hundreds of millions of ounces sitting in storage, ready to be delivered. In 2020, the vaults were actually overflowing. JP Morgan had just accumulated their massive hoard during the March 2020 COVID crash. They had ammunition, they had metal, they had physical silver they could dump on the market. In those years, the banks had bullets in the chamber. They could step in after the holiday Ghost Week rally and smash the price back down if they wanted to. They could flood the market with supply. They had the power to control the situation. In 2025, the gun is empty. We showed you the data in part 3 of this series. The Asahi Vault lost 1.4 million ounces in a single day. A single day. The swap rate is minus 7%, which means we're in backwardation, a condition that technically shouldn't exist in a normal market. The Shanghai premium is $5 over New York, which is massive. This is not 2010 with favorable conditions for a rally. This is 2010 on steroids, on amphetamines, on rocket fuel. The rubber band is stretched 10 times tighter today than it was back then. The spring is compressed 10 times harder. In 2010, we rallied because of speculation, because of momentum, because of chart patterns. In 2025, we are rallying because of starvation, because there is no metal left, because the physical market is completely disconnected from the paper market. If the price gaps up next week, the banks cannot smash it back down the way they used to because they have no metal to dump on the market. They can't execute their traditional paper smash strategy because the arbitrage bots in Shanghai will immediately eat them alive. Those bots will buy every single contract and ship the metal east before New York can even react. We are entering a Ghost Week with zero liquidity and zero inventory. That is a combination we have never seen in recorded history. Not in 1980 during the Hunt Brothers era, not in 2011 during the post-financial crisis commodity boom. Never. This is uncharted territory. There's also a psychological factor at play here that most people are completely missing. Institutional FOMO. Think about the portfolio managers, the hedge fund traders, the pension fund allocators. They are sitting at home right now with their families. They're checking their phones between courses at dinner. They see silver at $72. They see the year-end performance numbers. And they know deep in their gut that they are dangerously underweight commodities. They own too much technology. They own too much cryptocurrency. They own too many AI stocks. And they own zero silver. Absolutely nothing. They are looking at the same Venezuela headlines we are. They're seeing the same Fed policy pivot. They're watching the same dollar weakness. They're aware of the same supply constraints. If the market gaps up by $3 or $4 on Monday morning, those managers are going to panic. Pure, absolute panic. They have a fiduciary mandate to generate returns for their clients. If silver becomes the only asset class that's actually moving in January, if everything else is flat or down, they have to buy it. They have no choice. It's their job. And because it's Ghost Week, because liquidity is at rock bottom, their panic buy orders will hit an absolute vacuum. A few $100 million from a single panicked pension fund is enough to push silver from $75 to $80 in a single afternoon when the volume is this pathetically low. The danger for you, the retail trader reading this right now, is getting shaken out right before the explosion happens, getting spooked at exactly the wrong moment. The banks know this history too. They've studied every Ghost Week. They know the patterns. They might try one last head fake on Monday morning. They might try to dump a few thousand contracts right at the market open to drop the price sharply to $70 or even $69, hoping to trigger your stop losses, hoping to scare you out of your positions, hoping to steal your shares at the bottom before the real move begins. Do not fall for it. Do not be the sucker. Remember the ghosts of Christmas past. Remember the traders who sold silver at $29 in December 2010 and then watched helplessly as it ran to $50 4 months later. Remember the people who sold at 23s in December 2020 and missed the entire rally to $30. Do not be the guy who sold the absolute bottom of the breakout because you were scared of a holiday shadow, because you were spooked by noise. Now, what do you actually do? How do you trade this situation? Do you buy aggressively at the open? Do you wait for a pullback? What happens if the gap is down instead of up? What's your plan? This is the most important part of this entire message, because being right about the direction doesn't matter at all if you get liquidated before the move happens. I have seen smart people, brilliant analysts, people who correctly predicted that silver was going to $100 lose absolutely everything in a single week because they didn't respect the volatility, because they used too much leverage. When the liquidity disappears tomorrow morning, the market becomes a wild, unpredictable animal. It stops behaving rationally. It stops respecting support lines and resistance levels. It can whip down $4 in 5 minutes to liquidate your stop loss and then whip up $8 in the same hour. This is not a conspiracy. This is just math. This is just the mechanics of thin markets. This is the most important rule I can give you. If you remember nothing else from this entire series, if you forget everything I've said, remember this one critical point. Do not use high leverage next week. Period. End of story. If you are trading futures with 10x or 20x leverage, or if you're buying short-dated call options that expire in January, you are not trading. You are gambling. You are playing Russian roulette with 5 bullets in the chamber. In a liquidity vacuum, we see things called widowmaker wicks. This is when a massive market order hits the paper-thin order book, and the price instantly teleports down to a completely irrational number, say $65 or even $60, for exactly 1 second, sometimes less, before snapping back to $72 like nothing happened. If you are highly leveraged, that 1 second wick will liquidate your entire account. You will be wiped out at the absolute bottom tick, and then you will watch helplessly, paralyzed as the price recovers and proceeds to go to the moon without you. You'll be sitting there with $0 while everyone else gets rich. Do not try to be a hero next week. Do not try to maximize your returns. This is not the week for that. If you are holding paper positions, reduce your position size immediately. Widen your stops to give yourself breathing room. Or better yet, remove the leverage entirely and just hold spot positions or physical metal. This is a week for holding, not for scalping. This is a week for patience, not for action. Ghost week is deceptive. It tricks you. The moves that happen between December 26th and December 31st are often just noise. They are driven by skeleton crews making random decisions and algorithms executing pre-programmed patterns. The real signal, the real truth you need to pay attention to, is the open of the first full trading day of 2026. That day is Friday, January 2nd. This is when the big boys turn their terminals back on. This is when the hedge funds, the sovereign wealth funds, the major banks, the real players with real money, re-enter the room and look at what happened while they were gone. The bullish confirmation signal. If silver opens on January 2nd and immediately within the first hour of trading breaks above the Ghost Week high, for example, if we trade up to $74 during Ghost Week and then break cleanly above $74.50 on January 2nd, that is the green light. That is the confirmation. That tells you the institutions are chasing the move, validating it, supporting it. That is when you add aggressively to your position with confidence. The bear trap scenario, if we see a massive gap down on January 2nd, if we open sharply lower, do not panic. Do not sell in fear. Watch the $70 level very carefully. As long as $70 holds as support, as long as we don't break below that key psychological and technical level, the uptrend is still intact. The bull market is still alive.